economy has slowed to a crawl, yet the share market is booming, even though profits at some of Australia's biggest companies are falling.
Overall, earnings were actually downgraded around 4% into next year. But what was most surprising was probably the market's reaction to that. I mean, markets just shrugged it off and continued their march.
Expectations weren't particularly high coming into this earnings season. I think there was a lot of, angst in the market regarding where the economy was.
One reason for that angst is consumers are running down their savings, but they're not cutting back as much as retailers feared.
Many investors were expecting a hit or a slowdown of sorts in the sales that those businesses were likely to see. That didn't eventuate and indicates the trough in consumer spending is behind us.
But the outlook isn't so bright for the mining sector. Our biggest trading partner, China, is grappling with a property downturn and a slowing economy. It's buying less iron ore and coal, which are Australia's two biggest exports. Analysts have downgraded their estimates of future earnings for materials, utilities and other sectors, while tech and financials are expected to do well.
We're relatively cautious on the market. The market has been quite exuberant on the expectation of interest rates declining in the US.
The US Federal Reserve will start cutting interest rates next week, while Australia's Reserve Bank has ruled out the idea of rate cuts happening anytime soon, saying inflation is still too high. The prospect of cheaper money has led to Wall Street's tech and AI stocks surging to record highs. The ASX is following that wave of optimism, also setting new records.
What we're observing are lofty valuations. Right now, the Australian equity market's trading on a forward PE multiple of 17 times earnings. Now, the long-run history forward multiple for the Australian equity market is 14.5 times, so that's quite a premium.
One way to look at whether investors are paying too much is to compare a company's share price to analyst predictions of its earnings over the next 12 months. For example, Commonwealth Bank's stock is 24 times higher than its expected future earnings per share. It's more expensive than the ASX 200, other major banks, and even tech giants like Google and Facebook.
I just can't see a world where the valuations are justified, and although it might not happen next week or next month, I do expect the returns from here for the bank sector are quite limited.
But no one's willing to sell because a lot of people are sitting on big capital gains and then have quite a big tax position if they're going to sell.
Many analysts say the best opportunities lie elsewhere.
Businesses with strong brands and established positions in that market, if anything, are gaining market share and certainly weathering the storm better than small and medium-sized businesses.
I quite like the high dividend yield plays at the moment, particularly as we have interest rates decline. So that is the likes of Telstra, Spark Infrastructure, Transurban, to name a few.
Gold equities, some infrastructure assets and property if we avoid a recession are some of the strongest areas for investors to be looking at.
That's if you've got any cash left to spend.